Welcome back to our course on fintech risk management. Today we're going to talk about management and control to reduce risk, and we're going to explore what do we mean by risk in fintech. Now, in fact, there are four kinds of risks in financial institutions. Most of the focus in banks or insurance companies is on two kinds of risks. Most of the focus is on market risk and credit risk. Market risk is the risk that your investments will go up or down in value. You don't know whether they're going to go up or down, but stocks, bonds, other investments will increase in value or decrease in value. Your foreign currency will increase. Your bitcoins will increase or decrease in value. That's market risk. Credit risk is the risk that you loan money to someone and they won't repay you. So that's the risk of default. And that's different from market risk. There may be some correlation. Maybe you loan money to someone and you own stocks or bonds in their company as well. So you might have some correlation. But they tend to be somewhat different and tracked differently. You think of your credit risk as your loan portfolio, your market risk as your investments in various activities, real estate, other ventures, assets that the institution owns. But there's two other kinds of risks in financial institutions which are growing in terms of risk and are higher in fintech firms than they are in traditional financial institutions. One is operational risk. This has risk of you're mismanaging your people and they're doing things that are riskier than they should. They're behaving inappropriately. And so you have some risk from operations going bad. Sometimes this risk can be extremely high. It can take down your firm. And so that's very high risk. Sometimes it's risk of external actors, not management within the firm, but you were hacked or you were attacked or robbed. And so that's operational risk. And sometimes it's IT systems fail or fail to operate as they should, and that leads to types of risk, operational risk. The fourth is business risk, and that's the risk that your company is going to be attacked by competitors, you're going to lose market share, you'll lose customer loyalty, you'll lose brand value, you'll lose reputation. This is business risk. You got into the wrong business, you decided to expand into some other countries, you increased your activities in South America, just as some revolutions happened or some economies went under, and you said, oh, shoot, we made a bad business decision, and that cost us some money. Or a deregulation opened up your markets in some way, and that cost you some money. So you can have business risk that is independent of market risk, credit risk, or operational risk. Now, the nature of these risks are inherently different. And I'm going to introduce a complex set of ideas now about risk. This complex set of ideas about risk has to do with derivatives. And here I don't mean financial derivatives. If you work in banking or insurance and you hear the word derivative, you're probably thinking of a particular kind of financial instrument, like options or futures. That indeed is a derivative, and it relates to the term derivative that I'm going to use here, but I'm using it in terms of mathematics. And this is a measure of change. To make this easier to understand, what do we mean by the second derivative or second moment, third derivative or third moment, or fourth derivative or fourth moment? I'm going to try to draw an analogy to the physical world because it might be easier for you to understand than it is to understand it in a financial context. And then I'll bring it back to finance. In the physical world, my location is a measure of distance or place. And so I could be at home or I could be at work. If I want to go from home to work, I probably have to journey somewhere, either walking or in a car. Let's assume I have to drive, and I will get there at a certain velocity. And that velocity is distance over time. So I'm now taking it over time. And so if I were to measure that velocity, I could say on average, I'm going to go to the office at 30 kilometers an hour. And that's the speed at which I will go from one place to another. But that distance movement, or movement over distance, may not be a constant 30 miles an hour. And so the difference of my velocity over time, because sometimes I hit rush hour traffic or sometimes there's a stoplight, my velocity may be very different. Therefore, I could say on average, I'm going 30 kilometers an hour, but sometimes I'm going 10, sometimes I'm going 50. And so my average is not the same as my velocity at any particular moment, and that becomes a measure, or measuring that becomes a measure of the distribution of velocity. And if about half of the time I'm going faster than 30 kilometers an hour and half of the time I'm going slower, I might have a normal distribution. You may hear that term, which says that there's a bell-shaped curve, that sometimes you're going faster, sometimes slower, but the odds of you going 100 kilometers an hour are kind of low, and the odds of you going less than 10 kilometers an hour are kind of low, and so you'll have a distribution of velocities. Now, if you were to say, okay, I understand that, okay, so the second derivative of place is speed. What's the derivative of that? The rate of change of speed is called acceleration. And so if I want to change my velocity from 10 kilometers an hour to 50, I might do that quickly if I'm in a Tesla or in a Ferrari. I step on the accelerator and it goes fast. Or if I'm in a small Toyota economy car, it might not be so fast. Now, I'm not being critical of Toyota. I actually drive a Toyota and I like it. So I'm not saying it's a bad car, but it doesn't have the velocity of a Ferrari, nor does it have the acceleration of a Ferrari. And so occasionally it's nice to jump into a Tesla or a Ferrari and step on the accelerator and see, whew, that's a fast car. It's not so much that's fast. I can go fairly fast in an economy Toyota, faster than the speed limit would allow me to go, but I can't get there fast. So that's acceleration. That's the third moment, is the degree to which speed changes. I'm not changing my distance now, I'm changing the rate of change of distance is changing with acceleration or deceleration. And so that's the variance of the variance, if you will. Given that the variance of distance is speed, the variance of speed is acceleration. The fourth moment is the change in that. So the uncertainty about acceleration. So I would have this idea called kurtosis as the fourth moment, which says that things are uncertain about acceleration. When I step on the accelerator, sometimes nothing happens. And sometimes it goes like a rocket ship. It's just, somebody put nitrous oxide into my car all of a sudden and that's amazing. And so acceleration is inconsistent. That would be a fourth moment issue. Now, what does this mean for finance? Well, the standard deviation is very typical in market risk. We don't know if stocks are going to go up or down. There's a high degree of variance in the stock price. We know it's not going to be the same from day to day, so the variance is high. But the skewedness, meaning is it likely to be much higher than average most of the time and then occasionally much lower, that has to do with the shape of the curve. And that's pretty low. Credit risk has moderate dimensions on all three of these derivatives. And operational risk is different, almost the opposite of market risk, in that most of the time the risk is low. The standard deviation is pretty low. Operational risk is fairly low most of the time, but occasionally it really hits us. And the skewedness is the degree to which there is a non-normal curve. That curve is unusual in its shape. It's skewed one direction or another, Either way, it's not average. Its fourth moment is the degree to which it has a big or long tail, meaning that much of the time the outcome is highly unexpected. So operational risk has this long tail phenomena, and that means the risk when it happens could be really, really bad. Hacking is unlikely, it doesn't happen that often, you're not going to be affected by it that much, but when it happens, it could kill your company. So that's a high kurtosis effect. And so that means operational risk is different in its nature than other kinds of risk. And in some cases could be devastating to the outcome of your firm. Now I'm going to give some examples of each of these in our next session as we talk about some examples of problems companies have faced in managing risk from a managerial perspective and an operational perspective. Thank you.